All right, let's get right into it. We're breaking down the May 25th, 2026 edition of Big Bro's Weekly Money Dump. This is your explainer for taking all that dense market data, the big macro shifts, the institutional positioning, and actually translating it into stuff you can use. We've got a massive week to unpack, one where the hard data literally proved some of the most ambitious market theories out there. We gotta start with the newsletter's opening mantra. The time to stay is when the thesis keeps printing. That sets the absolute perfect tone for this week. We finally saw macro predictions meet hard, undeniable data. The market has been holding its breath for this kind of confirmation since January, and man, did it deliver. It's just a great reminder that when the fundamentals actually validate your strategy, patience is the ultimate play. So here's our roadmap for today. We're going to hit the macro and market moves, dive into energy and geopolitical trades, look at crypto becoming systemic infrastructure, unpack what they're calling the Qualcomm paradox, prep for the upcoming macro catalysts, and finally wrap up with a portfolio review and some alpha. Let's go. Okay, Section 1, the macro and market moves, validating the thesis. Let's dive right into the massive macro data drops. We just watched the S&P 500 close out its 8th straight green week. That is the longest winning streak we've seen since late 2023. And the Dow hitting fresh intraday all-time highs. But the real story, the thing that completely flipped the script from all those jittery inflation fears to just pure, unadulterated confidence, came from one company on Wednesday night. Nvidia. They reported an absolute monster number, $81.6 billion in revenue. That's $2.8 billion above estimates. And honestly, what's even crazier is they guided Q2 at $91 billion, which blew past consensus by over $4 billion. This totally shifted the market vibe, proving the AI infrastructure cycle isn't plateauing at all, it's actually accelerating. It was basically Jensen Huang telling the whole world that the AI build-out is happening way faster than even the biggest bulls expected. Now, if you were sitting there worrying about, say, one single tech giant pulling back and tanking this entire trade, just break down where that money is coming from. You can definitely breathe easy. Yeah, 50% comes from the big tech hyperscalers, for sure. But that other 50%? It is now totally diversified across AI, cloud, enterprise, sovereign AI, and industrial sectors. The demand is fundamentally widening out. Plus, that whole loss of the China market, it's already fully priced into the base. The AI thesis was absolutely spot on. Meanwhile, let's look at the consumer side. Walmart reported 4.1% U.S. comp sales growth. And what's absolutely vital to understand here is that people aren't just paying higher prices for the exact same stuff because of inflation. There's actually more foot traffic. Real people are physically walking through the doors more often, though they're increasingly picking up private label items. So yeah, the consumer is definitely squeezed by $4 gas, but they are not broken. They're just being highly practical. And honestly, that's a sign of economic health, not a collapse. Moving on to Section 2, energy and geopolitical trades. The energy trade is transitioning. Let's see how this broad macro picture plays out in the energy sector, because it's going through a super fascinating transition right now. We're seeing shifting geopolitical winds combined with massive M&A activity that's totally validating the portfolio positioning we've been talking about. Big Bro points out that reports of a preliminary Iran peace framework are starting to deflate oil's war premium, even though oil is still holding strong right around that $96 to $100 mark. But get this, at the exact same time, Devon Energy is making huge moves. They completed their Katera merger way ahead of schedule, and on top of that, acquired 16,300 net undeveloped acres in the Delaware Basin. It's kind of like buying the best house in the neighborhood and then enthusiastically buying up the one next door, too. No surprise, Morgan Stanley immediately bumped their price target for DVN up to $66. All right, Section 3, crypto becomes systemic infrastructure, digital transformation. Big Bro, translation. Now, this is where things get really interesting. The newsletter makes a great observation about how crypto is shifting from this speculative side quest into actual systemic financial plumbing. It's really not just some alternative asset class anymore. The explainer highlights this stark contrast between Ethereum's current struggles and Solana's insane momentum. You've got Ethereum, the older incumbent, facing real organizational risk. 8 senior foundation researchers have already departed in 2026. But then you look at Solana, the historically volatile newcomer, and it's holding strong at $84, seeing the exact opposite trend, rising institutional ETF inflows. And get this, Coinbase just rolled out a feature letting users borrow up to $100,000 against their Solana without even having to sell it. So yeah, Solana has officially crossed that line from a speculative token to literal balance sheet collateral. So the big takeaway here is that these moves by traditional finance giants, they represent true, deep integration. Look at BlackRock. They're building a second tokenized money market fund on Ethereum to give stablecoin users regulated cash management. And Charles Schwab, a beast managing $12 trillion in assets, is opening up spot crypto trading to retail IRAs, and they're actually recommending a 7% allocation. That is wild. This isn't just a flash-in-the-pan catalyst. We are talking about the creation of structural, decade-long demand baked right into everyday regulated wealth management. Next up, Section 4, the misunderstood Qualcomm paradox, the chip company Wall Street is getting wrong. Let's pivot to our stock deep dive. Honestly, this is a classic case of Wall Street analysts staring into the rearview mirror while a company completely transforms right in front of them. 38. That is the number of analysts who still rate Qualcomm as just a hold, slapping an average price target on it of around $175. But wait, the stock is already trading between $195 and $238, and it's up 37% year to date. Like, how is there such a massive disconnect between analyst perception and what the market is actually doing? Well, Big Bro argues these analysts are just trapped in the past. They're grading Qualcomm like it's still just a smartphone chip company that's terrified of Apple. But what's the actual reality? They just posted a $10.6 billion revenue beat. Their automotive segment hit an all-time record of $1.33 billion, which is up 38% year over year. They even confirmed that a custom data center AI chip is shipping this year. You combine all of that growth with their QTL licensing moat, which, let's be real, is essentially a permanent cash machine, and you're looking at a diversified AI platform company trading at a crazy cheap 19 to 22 times earnings. And that, my friends, is exactly why their June 24th Investor Day is the major re-rating catalyst you absolutely need to circle on your calendar. That's when the broader market is finally going to wake up to this shift. Moving on to Section 5, the upcoming macro catalysts, the last data before June 16. Zooming back out from individual stocks, we're heading into a super crucial week of macroeconomic data. Think of this timeline as the final exam for the new Fed chair, Kevin Warsh, right before his highly anticipated June 16th rate decision. Literally every position in your portfolio has a stake in these numbers. So after taking Memorial Day to review your portfolio positioning, Tuesday drops consumer confidence. We'll see if the vibes match Walmart's strong spending data. Wednesday hands us the FOMC minutes, basically the game tape from Jerome Powell's final meeting. But Friday is the make-or-break moment. We get the PCE inflation data. If core PCE comes in soft, like at or below 0.2%, it gives Chair Warsh all the economic cover he needs to pull off a historic rate cut in June. Finally, Section 6, Portfolio Review and Alpha, the 2026 Portfolio Tracker. So how does tracking all these macro trends, the geopolitical shifts, and the microstock catalysts actually play out in the real world? The tracker brilliantly shows the power of taking top-down macro validation and turning it into bottom-up portfolio returns. Just take a look at the actual numbers. You've got Uber up over 21%, Micron up 25%, riding that AI memory thesis, and the XLE Energy ETF up over 26%, perfectly capturing that geopolitical war premium. It's absolute proof of why you do the fundamental work before the catalysts even arrive. The final tally? By generating roughly 20% year-to-date returns compared to the S&P 500's 3.6%, the Big Bro strategy has cranked out a massive 16.4% of pure alpha. And remember, this wasn't on easy mode. This was achieved through an international war, a hot inflation cycle, and an unprecedented Fed chair transition. The plan, plain and simple, is working. But hey, the market never sleeps, and neither should your risk management. As we brace for Friday's critical PCE data drop, I want to leave you with this one huge question to ask yourself. If that inflation data comes in hot, is your portfolio actually built to endure a higher-for-longer reality under Chair Warsh? Or are you just flying blind, completely relying on the hope of a June rate cut? You've got to build a plan for both outcomes. That wraps up the Explainer for this week. Keep analyzing, keep learning, and stay focused.